Accurate helps insurers to inject game-changing speed and accuracy in their pricing process with their AI-based end-to-end pricing solution. It automates risk modeling while keeping full transparency and control on the models created, as required by regulators worldwide. In this session, together with Munich Re, they will discuss how new pricing technologies can help insurers tackle arising business challenges in P&C and present an inspiring use case in e-mobility. Please welcome Accurate.
Hi everybody, I'm Sam from Accurate. Very happy to be here with you today, where we are hosting this panel on new mobility and its impact on insurance, with challenges and opportunities for insurance companies. Before introducing myself, I'm going to let my great panelists introduce themselves, starting with you, Davide, maybe.
Thanks, Sam. So, good morning, everyone. My name is Davide Burlon. I'm representing the consulting arm of Munich Re today, and we have been in partnership with the Accurate, with Sam and the team for quite a long time, especially in the retail space, in the consultancy for the retail business.
Pepe?
Hi everybody, good morning. My name is Pepe Castelo. I'm Senior Advisor at Accurate, and I'm here just to talk about how mobility is changing and how those changes are going to impact in the way insurance companies price their policies. Happy to be here.
Thank you very much. And so on my side, I'm Falmagne, and I'm CEO, co-founder of Accurate. As mentioned in the video, Accurate is an insurtech dedicated to insurance pricing. And our expertise is to apply machine learning onto this use case to bring automation, increase predictive power of the models, but keeping transparency and control, which are prerequisites on this use case. We have more than 80 clients globally in 30 different countries. So before deep diving on the impact of new mobility, especially on insurance, when we talk about new mobility, what do we talk about? So let's just mention 5 big trends that we see globally, and then we'll see their impact on insurance. First one, of course, the rise of EVs, more and more present, pushed by the regulator. It's something that nobody can ignore. Second one, new lightweight materials that are so lighter, stronger, that allows to reduce the weight of vehicles without compromise on security. Third one, of course, the rapid rise of connected vehicles. Then we should mention as well as a trend, the new mobility preference of the newer generation. We see that more than 50% of new generation prefer to move to pay-per-use mode when talking about mobility. And last but not least, of course, autonomous vehicle, where we see now that the question is not anymore if, but when. So these are just 5 macro trends impacting not only insurance industry. And the objective of this panel is to see, well, how those trends translate onto the insurance industry and what's their impact. And so maybe we're going to start by a first question for you, Pepe. So looking at those trends, so which are the ones that are especially applying to insurance and how they are affecting insurance industry?
Yeah, so you're absolutely right, because those 5 trends in the automotive industry and how we change the way of our mobility is also impacting in the insurance industry. And just to make it simple, we can differentiate between those trends that are impacting today and are going to impact during the next 2-3 years, and which other trends are going to impact in the future. So starting for the short term, I would like to differentiate between trends that are impacting in the car, trends that are impacting in the habits of the drivers, and trends that are impacting in the market. So from the car point of view, it's clear that all technology that is included in the cars are impacting in how we price and how we repair those cars. In terms of pricing, it's clear that all those sensors and cameras that are embedded in cars has an impact in frequency. In theory, it's going to allow drivers to have less accidents, which is, of course, good for business, but at the same time, it's clear that it's going to have a multiple impact in the average cost. Why? Because those parts, I'm talking about bumpers or windscreens, are going to be more expensive, are going to be more demanding in terms of repairing those parts. Probably the body shops that are going to repair those cars are going to have highest labor rates. And finally, probably it's going to be more difficult to repair. So replace will gain market share. So all those impacts will have an effect in the average cost that actuaries and specialists on price needs to take into account. Of course, the second trend, and we will later talk about, is about how electric cars will impact. It's clear that in terms of, again, frequency probably will be lower, but cost will be higher. And how actuaries are going to manage those changes in their models, it's going to be key. From the driver or customer's point of view, it's clear that we are changing as human, as drivers, because first, after COVID, we prefer walking, or we prefer cycling more than the past. Also, government are subsidizing public transportation, so it will have an impact especially on big cities. There is also a trend on being more aware about the climate change and sustainability. So especially young generations prefer using micromobilities options more than a car. And a third trend is using versus buying. So probably car sharing is going to be a hard topic in the future. And the third part is the market. So we as an industry need to apply those changes at the same time that we are facing probably the highest combined ratios in the last 20 years. So it's going to be difficult because we have to change on the fly, and we have to keep an eye on the P&L. At the same time, we talk about future. And this is about short term, but this is not enough. We also need to talk about what's going to happen in the future, in the next 5 to 10 years. And in this regard, again, from the vehicle point of view, it's clear that connected cars is going to change the way we underwrite and price, because we will have on real-time information about car performance and driver behavior, so we can change our pricing on real time. And what to say about autonomous car, and where we are shifting the liability from the driver to the car manufacturer, or why not to the technology provider. In terms of the driver, again, car sharing, it's going to have a main role in this industry. I just yesterday read that Mapfre is launching a new solution, a new product that is more personal-based insurance more than car-based insurance. So depends on your preferences on how do you want to move in the cities. No matter if it is by taxi, by metro, by bus, or in a scooter, a stand scooter, electric bike. So you configure your needs of mobility, and the company gives you a price with a full coverage for liability, your own personal damages, and the damages to your vehicle. So congratulations to Mapfre and other companies that are following in the same direction, because it's, to me, the future. And finally, talking about market, as technology is evolving, is around the car, probably manufacturers will take advantage of that to gain more power in the insurance industry, because probably they think they own the customer. And so it's going to be I don't know if a fight or a partnership between carriers and OEs, just to decide who owns the customer. There is the possibility to new technology insurance companies that probably they are less advanced in risk management, but they know much better than the traditional companies the customer preferences. So probably those new companies, it's going to have an important role. And why not leasing companies that are now investing on how they can provide different solutions for mobility to their customers. So again, altogether, describe a very, very interesting and exciting world for the next years.
So thank you. Yeah, thank you very much, Pepe. And no doubt, it's those new mobility trends is something that no insurance company can ignore. Having looked at very briefly at those trends, long-term and short-term implications, I think now it's important to understand how insurance companies should adapt, or even more should evolve to get the most of those trends. So, Davide, what would you suggest for insurance company to really embrace this change, or to just adapt to this change that will happen anyway?
Yeah, it's an interesting point. Again, just maybe echo the analysis, right, by Pepe, because I think the biggest challenge for a risk carrier is the change in distribution. So the other mega trends that you were talking about, so like the emergence of new business models, the fact that you have to insure maybe closer to the person rather than the asset, and the data availability, maybe we get to that in a second. But for me, the biggest challenge, if you are a risk carrier, is this change in distribution with the emergence of embedded insurance, OEMs owning this deluge of data that can be utilized to assess risk. The data are also coming in extremely, not just in terms of, let's say, size of the data sets, but they become wider and wider because more points of information are collected. And the more OEMs maybe are taking up and jumping into this space, the more, if you are a risk carrier, the risk mix, the portfolio which is available to you, changes dramatically because the number of vehicles which are, let's say, your target addressable market changes dramatically. And this is going to be, I think, a massive change because, of course, OEMs will and have already shown that they want to own their data, they want to own the processes, they want to own the analysis and not share it necessarily with the carrier. So that's the biggest trend, I think, among the ones that you listed, that I think will have an impact if you are a carrier, a player. In terms of data availability, of course, it's not about, I think, anymore how long the data sets are, if you get what I mean, but rather what kind of extra piece of information you can enrich your data set for risk selection or behavioral pricing with. And so it's also the ability to sift through all of this noise with systems like Accurate that allow you, for instance, to do an automatic feature importance. So it's very easy, let's say, to find extra data points that make your data sets wider and wider. It's much harder to focus on the maybe 20 or 30 data points which are relevant for risk pricing, which are relevant for behavioral pricing. And these are all things that can be automated and should be automated, have seen a massive wave of automation in the past 3 years compared to when people like myself maybe grew up as a pricing actuary. We used to do a lot of this work manually. So this is becoming more and more, let's say, common practice in most of European countries, I would say. It's definitely an established trend in the UK market. If you talk about retail business, small commercial lines, of course.
And don't you think that instead of just projecting historical data just to predict the future, it's going to be more about modeling different scenarios, simulating different assumptions, because we have to manage such a number of uncertainties that what is only true is future is not going to be as past was. So the role of actuaries is not only just projecting historical data, it's about simulating new future, new scenarios, and analyzing different options and choosing some of them.
You know, absolutely. But I think what you were just describing, right, was maybe the bread and butter of just the very big players in the past, because it required quite a number of let's say, hands on deck, if you get what I mean, and a lot of technical sophistication, and it was difficult to get this information out of an actuarial department. What is becoming truer and truer is that now even small players, if they have the right piece of technology and if they put in place the right processes, they can generate a ton of scenarios. You can pretty much build these building blocks of predictions, which are your predictive models. And on top of that, you can use a system like Rate, Inaccurate, to generate all of the what-if scenarios, all the simulations, all the impact analysis, and you can pretty much generate a sort of an infinite number, if you like, of synthetic realities in which you ask yourself, as a manager, what would happen to my business if I did this price change? Yeah. What would happen to my volume? What would happen to all of the KPIs? And you can also become more and more, let's say, creative in finding which KPIs make more sense to track. And if you have a system in place where you don't need to scale up your team tenfold to do that at scale, then pretty much it's doable. It's within grasp also for small players.
Yeah. So as you mentioned, so there are definitely a need for data, need for technology to tackle those challenges. You've been mentioning as well changing the processes. So what do we mean by that in terms of organizational challenges that insurance companies have to tackle to get the most of those new mobility trends?
Yeah. To me, because future is so uncertain, to me the world is a collaborative decision. So I think the future of the company, the future of the pricing cannot be in hands of one single person deciding what's going to happen in the future. So collaboration and having a collaborative view, of course, actuaries and price specialists has to be in the center of the process, but they need to collaborate and they need to understand what's going on in the claims area, how bodily injury claims are going, or how material damages are increasing, or how the procurement departments are agreeing with the new providers, the condition for the next year, how macro trends are estimated by the CFO or the CEO. So to me, the world is the word. If I had to choose one word, is collaboration and having a collaborative decision. Mm-hmm.
Yeah, I tend to agree. So if you look maybe 5 years to 10 years back, it was more siloed, right? So there would be a very technical department, and then there would be someone who would be in charge of sales. And then there would be maybe a central function for data science that would try and test different approaches, different algorithms, and try to find that small marginality that could make you shine and get market share. What today I think is more true is there is much more integration between pricing actuaries, data scientists, data engineers, and decision makers. So I would say maybe the common point is collaboration, having collaborative systems in place, and a lot of, ease governance helped a lot, breaking a bit the silos between these central functions and functions which are closer to the market. But I think it's still an ongoing process. We're not there yet, I think.
Yeah, and you're both talking about collaboration and mentioning data science and actuaries. Do you see that, beyond the collaboration, do you see a trend of combining both actual science, data science? Do you see them more and more becoming one single profession, or actuaries using data science tools more and more?
No, absolutely. So, of course, data science in itself is such a huge, it's a buzzword, if you like, that covers everything, right? But if we stick to the areas of the value chain of insurance, where you select the risk, underwrite the risk, assess the likelihood of that risk to be retained, so everything which has to do with bottom and top line growth, I think there isn't a distinction anymore. I think there are nuances. So in our own team, we are a global consultancy. We have people that come in with maybe a pricing actuary label, and they start working with data science, or what used to be marked as data science approaches. And we have people that have maybe a data sciencey tinge to it, but they are not just developing algorithms in isolation. Everything that they do for the Munich Re group, they do so that they can make an impact in the pricing, in the behavioral pricing, in the market modeling. So it's everyone that has had work or has worked in the past with a primary insurance company, for instance. So you have to know what the business question you're trying to address is. Yeah. We are absolutely convinced that there is no, centralized pie-in-the-sky research data science that can make an impact to the business as of today. Data science, I think, especially deep learning, everything that has to do with images, videos, NLP, potentially large language models, is something that we have a right to play in, but that's something where I see a distance, because that's more Horizon 2, Horizon 3 ambitions, rather than, let's say, the bread and butter of risk selection and underwriting and product design.
No, absolutely. No, I fully agree, and this is really a global trend that we see, this convergence of data science, actuarial science, and data science really bring to the actuarial department this. One of the big benefits it's this capability of automation that allows to save lots of time for the actuarial department, so that they can spend time on actually processing data, on taking decisions, which is required in a world with those that is totally changing. So you cannot spend 90% of your time just applying statistics. You need to try to predict something that did not happen in the past, so it requires that you spend most of your attention on decision making, on data, instead of just building models, and that's really what I think one of the big added value of data science for actuarial departments. Do you agree with that, Pepe? You've seen actuaries in the last 30 years.
As an actuary, I think we are complementary with data scientists. We need their fresh air and their creativity, and with a combination of a deep insurance background could be the magic formula just to make the right decisions. So we need both skills and both talents from both sides.
Okay, and so we wanted to terminate this panel with a very concrete example on EVs. So Davide, I'm going to let you share this example.
So the idea is, everyone knows that this is one of the unmissable trends, right? If you look at just the growth figures globally and in Europe, probably Europe is just lagging behind China in terms of per year growth. On the top left here, you see the yearly growth. It's double digits, it's unmissable. As of today, more than 1 in 10 new sales are already electric globally, even more so in Europe. And within this, let's say, the span of the next 5 to 10 years, 1 in 2 vehicles globally will be an electric vehicle, be it a battery electric vehicle or a plug-in electric vehicle. So I think there's no debate to be had as to whether we should tackle this in the same way and with the same level of sophistication that we used to tackle normal combustion engines. This has impacts, of course, across the value chain. From a risk carrier perspective, from a reinsurance perspective, this is a complex phenomenon. It's literally a generational change within insurance, how products need to be designed, how these risks need to be priced. And until very recently, and for, I would say, the majority of the market, rating electric vehicles due to the lack of prior information, it's very hard to project this into the future. And so most players still go with very, very crude approaches. And it has an impact on sales, of course. It has an impact pretty much across the whole value chain. So Munich Re has recognized this quite early on, so we kind of led the way a bit also because we have the benefit of having a very, very broad exposure globally. And we have now let's say, a sound approach how we can help clients tackle this emerging risk, which is the reality today. So we start with an analysis on, let's say, more on the qualitative side, if you like, on how products are designed, what kind of covers should be taken care of, And we run a sort of portfolio analysis, if you like, with the same level of sophistication that is done with internal combustion engines, but with the insights that we bring to the table thanks to our global exposure. In a second step, we found already in the last 18 months, we can move to a step 2, if you like, is we can help carriers worldwide build very predictive models for the electric vehicles portfolio. So we are supporting clients globally, assessing these risks, pricing these risks, and we use a lot of accurate doing so. The use cases I wanted to kind of show you today is an illustrative example, and it leverages pretty much accurate across the various building blocks that allow us to build and merge, let's say, the traditional actuarial approach in building predictive models for the burning cost or the cost of claims, if you like, on very rich, EV-rich portfolios, and then augment the width, if you like, of these data sets with external data, the vehicle-specific data. This is something that can be done automatically in platforms like Accurate. And then there's a bit of, let's say, tips and tricks out of the actuarial profession in how you can merge these two pieces of information. So the external data enrichment, you reduce this hugely high-dimensional problem to a much more manageable problem. You smooth out the differences between vehicles, electric vehicles, which are very similar in their riskiness, if you like. And out of it, then you can enrich everyone's portfolio, every client's portfolio, with, if you like, a rank, a very predictive rank of TPL and comprehensive covers dedicated to electric vehicles. So if you like, this can be turned into an index, which can be used in many areas, right, of the value chain. Some of our clients use it purely for underwriting, so in terms of assessing what kind of appetite you might have for a certain brand and model. More sophisticated clients have moved already in using these ranks for attaching a price to it. So attaching, let's say, rate tables, and then having a system that allows them to monitor how and which price changes should be implemented as their EV portfolio grows with double-digit year-on-year growth. So all of this comes together in platforms like Accurate. It was extremely helpful in the risk pricing part. It was extremely helpful in the vehicle allocation, vehicle grouping part. And of course, it's driven by also global overview and global expertise, because let's face it, there is very few players out there that have such an EV rich portfolio that they can run these analyses independently and not ask for external overview, external advisory services. So that's more or less the idea, and we're happy, of course, to get into the details of it throughout the day.
Yeah, thank you very much, Davide. That was a very interesting use case. I think there is a QR code for the ones that want to scan with specific reports from Munich Re on EVs. It's nearly time of the end of this panel, so maybe time for a last question. Pepe, Davide, if you have maybe one last tip for insurance companies to make sure they get the most out of this new world, and they become like they are leading the change instead of just having to adapt.
So if I had just to summarize one single tip for the audience, especially for pricing specialists, is that it's time to spend more time with the output of the models and sharing those outputs and analyzing those outputs with your peers across the company, more than spending 80% of your time building those models. So future is going to change all our historical data. So spend more time on talking about future and potential future, more than spending time in the cave just cooking the numbers.
Davide?
I'm from Munich Re, right? So my message is focus on the core. Is 2023, you have to focus on pricing and underwriting.
Okay. Thank you very much. So we are getting to the end of this, this panel. Thank you very much for your attention. We've got an accurate booth right there if you want to continue the discussion on new mobility, on pricing, or whatever topic. So feel free to come and ask any question you like. Have a very nice day. Enjoy the conference, and thank you for your attendance.